So one of the questions that I've seen kind of floating around is why is it that higher rates are affecting growth relative to value? So I think it starts with, why is it the rates move higher? So two reasons. First of all, just flat out economic growth. So basically the expectations that demand and services are going to be high or they're going to be increasing. And I think we've kind of laid out that the easy monetary policy stance of the Fed, combined with the stimulus from the government, combined with COVID cases dropping, vaccines increasing, really increases the probability that we're going to get a more permanent reopening. And as that permanent reopening takes place, we should see jobs added, we should see money injected back into the economy, and we should see growth improve significantly. So that would take care of item one. Now, item two, inflation. So you have the erosion of purchasing power in the future, demanding a higher rate of interest today. So think about a dollar today is not going to be worth as much as it is 5 years from now if inflation picks up significantly. So those are the two things that are ultimately going to drive rates higher. Now, one can actually cause the other, but the other can't necessarily cause the first. So if we have a boom in economic growth, we could also see an increase in inflation. Very rarely do you see an increase in inflation solely responsible for an increase in economic growth. But what I think we're seeing right now is you're seeing both of these things kind of play themselves out at the same time. There's obviously expectations for growth, but I think there's also expectations for inflation being built in. So you've got this kind of tug of war on which one is going to be the good driver, which would be number one, versus the not so good driver, which would be number two, and which one of these things is going to dominate. Now, in terms of growth versus value, the best way to think about this is that growth businesses are considered long duration assets. So that means that most of the profit from the business is expected sometime in the future. So the chart we're going to look at the very end of the presentation is going to illustrate this really well. But we're not necessarily talking about the Amazons, the Microsofts, the Facebooks. Those companies make money and they make a lot of it. These are kind of these fringe growth assets that really haven't generated any profits, but they've created very compelling narratives along the way, and they've pulled a lot of assets. Whereas on the value side, those are considered short duration. So meaning most of the profit has already been established and is being generated currently by either earnings or dividends. So in an inflationary environment, money is worth more now than it will be in the future. Therefore, the cash flows that are being generated in the immediate future on the value side are going to be more valuable, so to speak, than those on the growth side. And as we've seen rates moving higher, we've certainly seen a dispersion being created between growth or NASDAQ indexes being hit versus value, or if you want to use the Dow as an example, but value specifically, the value sectors have maintained pricing power in this kind of choppy market, and they've actually increased as well. So we think that if rates continue to move higher, it should still continue to play into the value trade while most likely continuing to negatively affect the growth trade, so to speak. To see this visually, this is value versus inflation. So the graph or the legend on the left here basically just shows the annualized outperformance of value versus growth. So when we see numbers above zero, that means value outperformed growth, and below vice versa. And then we have decades going back to, I believe, the 30s on here, and then the annualized inflation rate here at the bottom. So what you can see is almost every period that we've had up here, we've had significant value outperformance against growth, has also been accompanied by an inflation rate that's been north of 2. The one exception is in the 90s, and if you remember the first graph that we looked at, a lot of this had to do with the fact that the tech boom at the end of the decade kind of skewed this return. So if you take the tech boom out of it, this number is probably somewhere up here. And then obviously the 2010s, when rates were significantly low, you had a big growth outperformance. And then in the 30s, when you kind of had the Great Depression, rates were pulled down, growth assets also outperformed them. So if we're thinking about inflation, we can see here visually that value is most likely to maintain a performance edge over growth assets in that environment.